investors see it as an opportunity to build wealth. Today, I'm going to share with you some powerful insights on how to not only protect your investments, but also make money during a recession. Let's get started. First things first, let's understand what a recession is. Simply put, a recession is a significant decline in economic activity. It's characterized by a contraction in gross domestic product, GDP, rising unemployment rates, and reduced consumer spending. Now let's learn how to invest and grow your portfolio during a recession. But before investing, we have to make sure our financial health is recession-proof. So for that, we have to learn about how to prepare for a recession. You can't control the market, but can learn how to prepare and protect yourself from losses. I'll share 6 valuable tips to recession-proof your professional life and portfolio. Number 1. Identify your financial priorities. The first step in recession preparation is reviewing and identifying your personal financial priorities. Take a close look at your goals and plans in relation to your current income and expenses. This evaluation will serve as a solid foundation for navigating your financial health. Number 2. Focus on budgeting. It's time to focus on budgeting. Regularly evaluating your budget is a powerful way to control unnecessary expenses. Identify areas where you're overspending and make necessary cuts. If needed, don't hesitate to seek guidance from a financial advisor who can provide valuable insights. Number 3. Build an emergency fund. As many experts suggest, having an emergency fund is crucial. Aim to save 3 to 6 months' worth of expenses to ensure you're well prepared for unexpected situations. Remember, your emergency fund should not compromise your retirement goals. Moreover, adding extra money to your emergency fund can be fruitful in the long run due to rising inflation and the potential threat of recession. Number 4. Prioritize paying off high-interest debt. During recession preparation, it's essential to minimize your debt burden. High-interest debt may appear affordable with monthly payments, but in reality, you end up paying more than the retail price. Start paying off your debt and building up cash reserves today. This will significantly strengthen your financial position. Number 5. Evaluate your investment options and diversify. Regularly evaluating your investment options is vital. Stay away from red flag stocks by performing a sanity check on your portfolio. By diversifying your investments, you can protect your portfolio from volatility at the right time. Use a diversification score to gauge the volatility level of your portfolio. The higher the score, the more diversified and less volatile it is. Number 6. Invest in yourself. Investing in yourself is a fantastic way to enhance job security and protect your income during a recession. Consider learning new skills to advance your career prospects. If possible, explore recession-proof fields like healthcare. Building a personal brand and acquiring freelancing skills can also create additional income streams. And don't forget to educate yourself about money management and personal finance to take full control of your financial health. By following this recession preparation checklist, you've ensured that your financial health is recession-proof. Now, you're ready to invest and grow your portfolio during a recession with confidence. Believe it or not, a recession can actually present incredible opportunities for those who are prepared. I'll share 6 key strategies to help you make the most out of investing during a recession. So, let's get started. Number 1. Invest as much as you can. The easiest way to get rich during a recession is to invest as much money into the stock market as you can. When there's a recession, stock market performance declines. Consumers spend less, and companies earn less, causing investors to worry. Some investors sell off part of their portfolio out of fear or because they need the money. For those who have money to invest, this is an amazing opportunity. Stock prices could drop by 20% to 30%, or possibly even more. Even though it may seem risky, the market has always bounced back after recessions. If you invest more when prices are low, you can effectively buy at a discount and earn big returns when the market recovers. As far as what to invest in, most people go with investment funds to keep it simple. Index funds that track the S&P 500 are a popular choice, as they get you exposure to the 500 largest publicly traded companies on US stock exchanges. Number 2. Own defensive stocks. In a recession, it's wise to own defensive stocks that are known for their stability and resilience. These stocks belong to industries that are less affected by economic downturns, such as utilities, consumer staples, and healthcare. These sectors tend to perform relatively well during challenging times because people still need essential goods and services, regardless of the economic climate. By including defensive stocks in your portfolio, You can provide a buffer against market volatility and potentially minimize losses. Number 3. Avoid growth stocks. While growth stocks can be incredibly lucrative during a booming economy, they can also be more volatile during a recession. Growth stocks are often priced with high expectations for future earnings. However, during a recession, those growth prospects can be affected, leading to potential declines in their stock prices. It's important to be cautious with these stocks during these times. Instead, focus on more stable investments that can weather the storm. Number 4. Invest in dividend stocks. Dividend stocks are particularly beneficial during recessions. They can provide a consistent income stream, acting as a cushion for your portfolio. Even if the stock prices of these companies fall, they may continue to pay dividends. Dividends can indicate strength and offer an opportunity to take advantage of market volatility. When choosing dividend stocks, consider companies with solid fundamentals, strong cash flows, and a track record of maintaining or increasing their dividend payouts. Conduct thorough research to ensure the sustainability of their dividend payments. Number 5. Bonds and uncorrelated assets. In addition to stocks, consider investing in bonds during a recession. Bonds tend to perform well during economic downturns as investors seek safer havens for their capital. Look for investment-grade bonds to minimize the risk of default. Government bonds, corporate bonds, and municipal bonds are commonly considered during recessionary periods. These bonds provide fixed income streams and can act as a stabilizing force in your portfolio. Furthermore, explore uncorrelated asset classes such as royalties, insurance-linked securities, and carbon credits. These assets may perform relatively well when traditional asset classes exhibit weakness, providing diversification and potentially reducing the overall volatility of your portfolio. Number 6. Buy quality assets. During a recession, it's essential to focus on quality assets. Look for companies with strong fundamentals, solid financials, and a history of weathering economic downturns. These companies are more likely to withstand the challenges of a recession and potentially recover faster when the economy rebounds. Conduct thorough research on the companies you're considering, analyzing their balance sheets, cash flows, competitive advantages, and management teams. Seek out companies with sustainable business models and a history of generating consistent earnings and revenue growth. By investing in quality assets, you position yourself for long-term success. If you enjoyed this video and found it helpful, don't forget to give it a thumbs up and subscribe to The Wealthy Listener for more insightful content. I'd love to have you as part of our community. Thank you for joining me today. I'll see you in the next video. Feel free to leave a comment. I read and respond to every comment because your feedback matters to me.